Welcome back to Investing Talk Podcast. Today, we're zeroing in on Draganfly, a name that's been making some significant moves in the drone world. We're going to sift through what's been happening with them, from their tech breakthroughs to their recent financial twists and turns, really to help you understand the full story. Our goal for you today is to cut through the noise, highlight the most important facts, and give you a a nuanced picture of this drone pioneer. Before we truly get into it, if you find these conversations valuable, please do consider subscribing, liking, and maybe leaving us a comment. It genuinely helps us know what resonates with you. And if you're feeling extra generous, you can always consider buying us a coffee to support our work. Okay, now let's unpack this.
What's really compelling about Draganfly, I think, is their history. It's quite extensive. They've been immersed in unmanned aerial vehicle technology for well over 25 years, so they position themselves as a pretty foundational player in the space. However, their very recent activities, they're revealing a great deal about the current, let's say, challenging dynamics within the commercial drone sector as a whole.
Okay, so let's lay the groundwork then. For those who might not be super familiar, what exactly is Draganfly's core business? What makes them, distinct in this space that seems to be getting more crowded?
Right. So Draganfly specializes in engineering some pretty sophisticated UAV systems and custom drone solutions. But crucially, their clients are mainly enterprise and government. This isn't about the consumer drones you might just buy off the shelf somewhere. Their focus is really on high-value, specialized applications across different sectors. Like public safety, defense, agriculture, complex industrial inspections, that sort of thing. They're building, let's say, purpose-built tools, not toys.
Okay, that clarifies their niche right away. Definitely not selling to hobbyists. Can you give us some specific examples, maybe standout products or key partnerships that really illustrate this high-value specialized focus you mentioned?
Certainly. And this is where I think their strategic differentiation becomes clearer. For instance, they've developed advanced drone platforms like the Commander 3XL. And this isn't just a concept on paper. It's a platform that has actually been adopted recently by branches of the U.S. Department of Defense.
Wow, the DoD.
Yes, which signals, a high level of trust and capability. Beyond that, they're developing these autonomous drone-in-a-box systems.
Drone in a box. What's that exactly?
Imagine a kind of self-contained unit, almost like a sophisticated weatherproof little hangar for a drone. The drone launches from it, performs its mission completely autonomously, maybe patrolling an oil field, monitoring instruction site, inspecting infrastructure, and then it returns to the box to recharge, all without a human needing to be right there on site.
Huh, okay. That sounds pretty advanced.
It is. That's the high-value, specialized automation Draganfly offers. And they've partnered with companies like Nightingale Security for Fortune 25 oil and gas giants on these systems. And even more recently, they were selected by the Cochise County Sheriff's Department for a border security drone pilot program.
Border security, too.
Right. So these aren't just, one-off sales. These are indicators of real traction in critical sectors.
That definitely sounds like a robust and strategically focused portfolio. But when we look at the sheer scale of the global drone market, how significant are these wins, really, in terms of moving the needle for a company Draganfly's size? Are they genuinely disrupting things, or are they more of a niche contender trying to break through against, the titans of the industry?
That's a good point. If we consider the broader market landscape, Draganfly positions itself quite confidently, actually, as an industry-leading drone solutions and systems developer.
Mm-hmm.
And they certainly leverage proprietary technology. That gives them a competitive edge, through innovation and customization, especially in those specialized applications we just talked about.
Wow.
However, fundamentally, they are still a challenger in the grand scheme of things. They're not a market leader.
Right.
They face really intense competition from much larger global manufacturers. Think of names like DJI, everyone knows them, or Parrot, and even defense-focused players like AeroVironment.
Big players.
Very big. So while Draganfly's niche focus provides that critical differentiation and lets them win those specialized contracts, their scale and market share are still, limited compared to these giants. And this often translates to lagging behind in terms of overall profitability and the ability to command massive market segments. They're proving their capabilities, definitely, but they're still fighting hard for significant market share.
That provides really crucial context. Okay, let's pivot now to their financial health, especially what's been happening recently. We've seen some positive revenue growth on one hand. What are those numbers looking like?
Indeed. If you look at their Q1 2025 revenue, it came in at $1,547,715,
Okay.
which is up 16% year over year. Product sales specifically, they saw a notable jump 24.5% in that same period. And looking back over the past 3 years, while the growth has been positive, it's probably fair to characterize it as, well, modest.
Modest growth.
Yeah, and for a tech company in a rapidly expanding sector like drones, modest growth can sometimes signal a struggle to achieve that kind of exponential scaling that, investors often look for. It can feel a bit like running hard just to stay in place rather than really sprinting ahead.
Right. That modest growth sounds okay at first glance, but then, as you hinted, we also hear about significant financial challenges. It tells a different story. What's the full picture here?
Well, this brings us to a really fundamental question. What does that top-line revenue growth actually mean if the company consistently struggles with profitability? Draganfly has persistent negative earnings. For instance, their Q1 2025 earnings per share was negative 0.44 cents.
Negative 44 cents.
Correct. Now, interestingly, that figure actually beat analyst estimates, but it's still a loss, a significant loss. Their price-to-earnings ratio, that common metric for valuing companies based on profit, isn't even meaningful here because, well, they're not profitable yet.
Right, no E in the PE ratio.
Exactly. So that immediately flags them as more of a speculative growth play rather than, say, a stable earner. But what's perhaps even more crucial to understand are their cash reserves. They were dwindling. They fell sharply from about $6.2 million at the end of the last fiscal year to just $2.21 million by the end of Q1 2025.
Wow, that's a big drop.
It is. And you couple that with a Q1 net loss of approximately $3.4 million and shrinking gross margins kind of hovering around 17%, this indicates a pretty significant cash burn.
Was doing the math quickly.
Yeah, to put that in perspective, at their burn rate then, they would have been out of cash in less than a quarter if they hadn't taken action.
Okay.
So that really highlights the urgency behind their recent financial maneuvers.
So it's clear they were burning cash, at an unsustainable rate. Which brings us then to those two very significant announcements from early June. A reverse stock split and a public offering happening almost back to back. Can you break those down for us, especially maybe for listeners who aren't super familiar with these kinds of financial tools?
Right. This is exactly where those liquidity concerns became, well, acutely apparent and really required some drastic measures. So on June 11th, Draganfly executed a 1-for-25 reverse stock split.
1-for-25.
Yeah. So that means for every 25 shares an investor previously owned, they now own just one. But the price per share, theoretically, increases by 25 times. Companies usually do this to artificially boost their per-share price. Often is to meet specific exchange listing requirements. Maybe avoid getting delisted if the price drops too low.
Right, stay above $1 or whatever the threshold is.
Exactly. Or sometimes just to improve market perception, make the stock appear less like a penny stock. Then, just the very next day, June 12th, they closed a public offering. This successfully raised approximately $13.75 million.
Okay, so they got the cash.
They got the cash. They did this by issuing 5.5 million units at $2.50 each. And just for context, each of these units included one common share and also a warrant.
A warrant.
Yeah, which is essentially an option that allows the holder to buy additional shares at a predetermined price sometime in the future. Adds a bit of a sweetener potentially.
Okay, that's a lot of financial activity in a very short span. What was the market's immediate reaction to these, well, pretty bold moves, especially right after that reverse split?
The market's reaction was quite telling. The stock dropped sharply. About 15.9% in pre-market trading right after the reverse split was announced. Yeah. The combination of these events, the reverse split, followed so quickly by the offering, it led to heightened trading activity, sure. But the overall sentiment was overwhelmingly bearish, negative. Reverse splits are, well, frequently perceived by investors as a distress signal. They rarely indicate strength or positive momentum.
Generally not a good sign.
Generally not. It often suggests a company is struggling, maybe to maintain its listing or attract institutional investors. And while the public offering provided that much-needed capital, that runway for operations we talked about, it also brought significant dilution concerns.
Right, dilution. Can you explain that quickly?
Sure. Dilution simply means that by issuing millions of new shares, the ownership stake and the potential future earnings per share for everyone who already owns stock gets reduced. It's like slicing the company's existing pie into smaller pieces.
Yeah.
Generally not great for current shareholders.
Makes sense.
And you saw this reflected in social sentiment, too, on various investor platforms. Lots of skepticism, many cautioning about these long-term dilution risks.
Okay. It certainly sounds like a mixed bag then, a company at a really critical juncture. Let's try to distill this for our listener. What are the key strengths that still make Draganfly noteworthy, maybe potentially attractive, despite these pretty significant financial hurdles you've just laid out?
Right. Despite the financial struggles, there are, I think, undeniable strengths.
Hmm.
Their double-digit revenue growth, even if we called it modest, it's still growth. That's a clear positive. More importantly, securing those high-profile contracts we mentioned with the U.S. Department of Defense, engaging with Fortune 25 companies for those autonomous drone systems. That genuinely validates their product quality, the advanced nature of their tech, and their relevance in some very demanding markets.
Yeah, those are big names.
They are. And their strong positioning as an innovator, both in drone technology itself and in AI-driven robotics, that's a significant asset in a world that's increasingly reliant on automation and data.
Okay. So on the flip side, what are the big red flags? The major risks that investors, or frankly anyone following this sector, should absolutely be aware of?
Well, this brings us back to that crucial question about future sustainability. The ongoing net losses are a major, persistent concern. A company just cannot bleed cash indefinitely.
No.
And closely tied to this is that dilution risk from the recent $13.75 million equity offering. While it provided a necessary cash infusion, it came at a cost to existing shareholders. And it could set a precedent if, more funding is needed down the road,
Right, more dilution possible.
potentially. They also have a heavy reliance on winning new contracts and partnerships just to keep driving revenue. This means their financial future isn't really secured by existing recurring streams alone. They're constantly in sales mode, needing to land the next big
A
deal.
lot of pressure there.
Absolutely.
Yeah.
And on top of that, they face that intense competitive pressure from the larger, more established drone manufacturers we talked about, the ones with deeper pockets and broader market reach. And finally, there's always regulatory uncertainty around commercial drone use. Things like flight restrictions, privacy concerns, airspace management. That remains an ever-present risk that can impact their operations and potential expansion.
Okay. So taking all of this into account, the strengths, the risks, the recent financial moves, what does this all mean for the future? Are there specific catalysts, things we can watch for that could genuinely turn things around for Draganfly? Or are the risks maybe just too significant to overcome in the long run?
There are definitely clear opportunities that the company is aiming for. That fresh funding from the public offering, it provides a critical runway. That capital is essential for continuing their R&D, which is absolutely crucial in a fast-moving tech sector, and for supporting new product launches. If these R&D efforts and new products hit the mark, if they're successful, they could drive substantial future revenue streams.
That's the hope anyway.
That's the hope. Their strategic expansion into government and public safety contracts also offers, I think, immense potential for more stable, perhaps recurring revenue, moving beyond those more volatile, traditional commercial markets. Specific upcoming catalysts to watch for? Yeah, definitely the delivery milestones tied to those recent Department of Defense purchase orders.
Yes. Proof is in the delivery.
Exactly. Hitting those targets on time and with the expected quality will be vital validation. However, the shadow of continued operating losses looms large. It could necessitate further dilution if sustainable profitability remains elusive. And that intense competitive pressure from the industry giants, that isn't going away. Their success really hinges on converting those impressive contract wins into a consistent, profitable business model.
So putting it all together, what does this look into Draganfly tell us? We've seen a company that's certainly a pioneer in a growing high-tech field. They're securing impressive contracts with major players, showing some top-line revenue growth. They've built some impressive specialized tools.
Yes, absolutely. But alongside that innovative spirit and clear market relevance, we also see a very clear picture of significant financial risks. These include those persistent operating losses, the rapidly dwindling cash reserves before the offering, and the challenges introduced by the recent capital raises and that impactful reverse stock split. The company is squarely in a phase where its innovation and its contract wins desperately need to translate into a sustainable, profitable business model. It feels like a critical inflection point for them.
Yeah, what truly stands out is this delicate balancing act you described. High-profile technology, validated market relevance on one side, versus the very real, very immediate challenges of scaling efficiently and achieving consistent profitability in what is, let's face it, a competitive and capital-intensive industry. You mentioned for investors the current recommendation often leans towards a hold, meaning what, monitor the situation extremely closely, paying particular attention to their execution on those new deals and, maybe most importantly, their demonstrable path towards clear, sustainable profitability.
That seems to be the general sentiment, yes. Monitor closely. And if we connect this to the bigger picture, may raise an important question for you, the listener, to consider. In a rapidly evolving tech sector, particularly one like advanced robotics and drones, how do you really evaluate a company like Draganfly? Is the potential for groundbreaking innovation and significant market expansion enough to outweigh ongoing financial losses, the need for continuous fundraising? Or does profitability need to be prioritized above all else, even for a company that's, working on the cutting edge? It's a complex decision, I think. It forces us to look beyond just the raw numbers and consider the long-term vision versus the short-term burn.
That's a great thought to chew on. Thank you for walking us through all that, and thank you for joining us for this discussion. Until next time.